Okay, so in this video I'm going to cover three principles that you can apply to your trading strategy that should hopefully give you some more confidence in which direction you should be trading in, and just kind of really boost your overall knowledge of the market. So I'm going to go through all three of them, and then at the end I'll talk through how they affected the trades that I actually took today, and then talk you through my gold trade also. So the first thing really is the training your eye to see peak formations. So by peak formations I mean this area here, so the highs and lows of the week really. So being able to see when a peak formation has been put in place, this is really useful, because depending on your strategy, obviously if you're a scalper it's not going to be really too relevant, but most strategies, the bias has gotten the higher time frames, and then we drop down to the lower time frames to find entries. So being able to spot peak formations basically lets you know when the high or low of the week is locked in, and then basically you can trade accordingly. So the way that I trade is so I get my bias in the higher time frame, I then wait for a peak formation to be put in place. So I can see here, this is the peak formation, wait for that to be locked in, and then simply wait for price to return to that, and then trade away from it. So there's pretty much four main different styles of peak formations. So, and literally the only way to get used to them or to figure out what they look like is just to go through the charts and just study the highs and lows. So for instance, here we can see this was the low of the week. So there's, as I said, four main types. So you got like your seek and destroy type behavior. This is mainly where they're switching the books or a big reversal. You got your double, triple tops. You got your inducement swing, and then head and shoulders. So they all look slightly different, but all serve the same purpose. So the seek and destroy typically will look like this type of behavior. So you get big swings, and then after that, then volume trapped inside. So we'll get a big push up followed by a big push down, and then price will just consolidate inside. So then our high and our low are actually locked in. So we have the high, have the low. This is our peak formation, and then everything inside then is just noise. So the second one then is your double and triple top. They're pretty self-explanatory. You got a triple top here, or you can call it a head and shoulders. As I said, they're all similar, but have slight different nuances. The inducement swing one then is when price will be, just say, trending down, and then we'll get a big inducement followed by a big pull up again. So that could be you could call it head and shoulders again, but again it's where we get a really exaggerated big fast swing, moves down. So basically the way this one works is, or the purpose behind it is to get traders shorting, and then pull the price back. So then everybody down here is then trapped volume. So everyone who's been selling down here is now trapped, so price will not return back to that level. So when you get a big inducement like that, don't anticipate price to actually come back down and mitigate any positions or look for entries down here. When you get one like that looks like this, you're going to be looking for entries in and around this area. So this would be your area of interest that you're looking for price to come back to. So price come back here, boom. And again, as I said, it's just a matter of going through the charts, pick a pair or two, and just study the highs and lows. So this one here, head and shoulders or triple top. What we got down here? Again, head and shoulders one. So we wait for it to be locked in, and then wait for price to come back and trade away from it. here, double tap, so very simple. So this is one here. Now this is an inducement one. So as you can see, you have got, if you want to call it, I know I don't really like trading patterns, but if you know what I mean, this peak formation behavior is an inducement swing one, but you can see it's also like head and shoulders. Here's a really nice inducement one. So price getting everybody shorting, and then immediately pulling price back. So when this happens, like I mentioned before, we're not going to be anticipating price to come down to these levels down here for any mitigation, because all of this price action down here is just all trap volume. So anybody who is shorting the market here is now trapped, and we're basically going to be looking for trades away from the top of the peak formation. So here, double top or triple top, whatever you want to call it, and another inducement one, but yeah, you get the picture. But basically, yeah, just having or training your eyes to be able to come to any chart and immediately see when a peak formation has been put in place provides so much utility. Because if you have your bias, for instance, my bias this week was short. This is pound yen, so my bias was short, so I was waiting for a peak formation to be put in place to the upside, and then I was just waiting for price to return to that to trade away from it. So the high's already locked in, and it's basically, I don't know if you want to call it a safety trade, or it's just, yeah, it's adding some insurance. So you don't need to be calling the high of the week. You can actually wait for it to be locked in and then trade accordingly. And the same way with everything in the market, these are fractals. So if we're dropping down to lower time frames, it's the same thing. So if you're trading, if you're trying to figure out when the high of the day is getting locked in, it's the exact same thing. It's going to look the exact same. You're going to have your triple tops, inducements, head and shoulders, etc. So the second thing then is marking out the highs and lows of the month, the week, days, quarters. Yeah, but primarily, yeah, you want to be marking out your highs and lows of the weeks and highs and lows of the months. So this is the layout that I use to mark out these. So I marked my highs of the week, highs and lows of the week in yellow, and then the month in orange. Obviously, it doesn't matter what color you use, but that's just the visual way that I put them on a chart. And then, because the thought process behind that is, not every trade that we place is going to require the same lot size. I know you have a lot of people's philosophy is to simply just place 1% risk per trade, or 1.5 or 0.5 or whatever your strategy is. People tend to use like a blanket risk, and personally I don't really think that that's the best approach, because different setups are going to have different probabilities, or not even probabilities, but also different like profit potential. So on your your highest probability setups, you want to be kind of loading the boat a bit more than just your average session trade. So when you have those sweet ones where this is one of your A-class setups where you've seen it play out time and time again, price is going to move fast away from the area, be quite a low stress trade, those kind of trades is where you want to be adding significant size, and typically those are found after highs and lows of the week and month are triggered. So as we can see here, GJ came up on, what day was that? Thursday even, sorry. Yeah, Wednesday, and pinned above the high of the week and the high of the month, and then trapped volume back inside. So it's also the first red day. So it's a term coined by, I think Stacey Burke coined that one. I definitely uses it, but when we're in an uptrending market, we got lots of momentum. The first bearish candle is a sign that price is ready to reverse. Obviously, it's it's a very basic principle, and you're not just selling off of a bearish daily candle. But when incorporated with other confluences, it can be a little useful. Just a way of, I guess, if you're scanning through multiple pairs, you can spot where a setup could be forming in the next couple of days, or the following day even. So, but yeah, the point I wanted to make here was just marking out the highs and lows of the weeks and months primarily. So we can see there on GU we had the exact same thing. So price had taken out the previous week's high and the previous week's opening price. I didn't mention it, but yeah, another really useful price point to mark is the opening price for the week. So ICT goes into great detail about this. You want to check out his video on the opening price, but yeah, I can cover that in a different video. But yeah, just having the highs and lows week, month, and the opening price marked really gives you a good basis as to where we are in the weekly template, whether, depending on what template is it going to be, is it going to be a trending week, a consolidating week. Irregardless, having these price points marked will give you a lot of information as to where we are and when we can anticipate big moves and high probability setups. So the last tip that I wanted to cover was to pick a take profit and stick to it. As we know, it costs money to move this market, so if price is traveling in a certain direction, it's not going there for no reason. There is an aim for it. It's basically going to make the bank's money. So whether that's in the form of mitigating an order block, like we have here, or if it's going to take out stops, like we have here, or if they're going to a psychological number. So for where institutions have their orders placed. Regardless of what you choose, it is going somewhere for a reason, so just pick a take profit and stick to that. If I could only take my own advice, I'll talk you through my trade, like for instance, like my trades here, so I'll talk them through in a minute, but basically, just I'm not pretending to be perfect by any means, far from it, but one of the biggest things holding me back is not riding my winners out. So it might just seem like a small thing, closing your trade in decent profit. Like, yes, there obviously is a debate that once you're in profit, you're then not only risking what your initial risk was, but you're also risking the profit you have. But if you go by that philosophy and you're cutting your winners short all the time, it really adds up. It really adds up. Like, if you can switch your thinking, which is what I'm trying to do at the minute, to instead of trying to take the profit that I get, how can I add more to my current position size and ride that out to the take profit? Because that's where the real money is. Like, that's where you get those serious gains. As I said, like it goes against all natural instincts. Like, especially if you're learning and you're just getting beat up the whole time, you might be coming off a couple of losses. When you see that blue, it's just like, oh, so difficult to not just snatch it up. But that really is what will make all the difference. And yeah, as I said, that is literally what I'm struggling with at the minute. So those three things there. So studying to train your eyes to see peak formations, marking out the highs and lows of the week and the month, and then picking a take profit and sticking to it. Those are three things that no matter what your strategy is, you can incorporate those and they will add some bit of depth to it, or some confidence at least. So yeah, now I'm just going to talk you through how that kind of applied to the trades that I took today. So today is, I believe, the 21st. Yeah, the 21st of July. It's a Thursday. So as I said, being able to spot the peak formations is very handy because my bias was short on pound yen and cable. So once we tagged the previous monthly high, the weekly high, pulled back inside, first red day, I was looking for short positions. So that's it on the higher time frame, and then when we translate that to the lower time frames, I can see this was the peak formation. So I was looking for a trade anywhere inside of this area. So waiting for price to lock in the high and then come back up into it. So I was actually on a date last night, so had some drink taken and did not get a good night rest. So when I woke up this morning, where was it? I was obviously anticipating to short this market today. And I woke up and price was down here and I was absolutely kicking myself. I was like, oh, damn it, I've missed the trade. So I went to the gym and I came back and I saw the price had actually pulled back up, so I was buzzing. So once we pump back up again, yeah, that's basically what I was waiting for. I was waiting for that pump back up behavior. So let me pull it up here. So apart from what we just covered there, the main components to what any strategy I believe should be based on is timing and price, because there's not many constants in this market and trying to trade specific patterns isn't really gonna work because no 2 days really look the exact same. The only two things that remain constant is timing and price, and everybody mentions that. Not everybody, of course, but like if you're talking about ICT, Stacey Burke, Steve Mauro, anybody who's taught or school of thought you've been through, all talk about the same thing, like price points at certain levels, highs of the lows of the week, timing. But yeah, basically, as I said, I had my bias from the peak formation being locked in from the higher time frame, so I was just waiting for price to come back up into this area, and then we're just watching the clock. So just think about it logically. As we're coming into the New York session, price is just in a creeping trend down. So just inducing everybody into shorts, and then just before the session starts, boom, 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 big impulse down, followed by this. So everybody's shorting this market at this point. This candle moving rapid. So once we got this pump back up again, then that's when you can start to lick your lips, because we already have our bias that's taken care of. We have the peak formation locked in, so we're just looking for a short opportunity. So basically, the higher that this comes, the better it is for us. So as you can then see, literally look at the clock at the bottom down there. As the new hour starts, we get a big pin up. So now everybody is initially short, pulls back, and now as the new hour starts, the hourly candle closes bullish. Everyone is now long. Once we get this engulfment and start to break down, that is when I shorted this, and my target was from the initial burst of the week. So the initial, whether you want to call it the order block or the initial pump, whatever, this is where the institutional orders were open, so this was my target. Like I mentioned, as I said, pick a TP and stick to it. This was my take profit. Price had to come down here at some point because there was open institutional orders here. If you want to use smart money concepts, order blocks, or whatever, there's open orders here, as we can tell by this sell before the buy. So price had to come down here. I'm actually on the verification stage for an FTMO challenge at the minute, and had I held my trades today, I would have passed the verification. So that's why I just did want to highlight, just pick it, take profit, and stick to it, because once I saw this pin come down and start to pull back up, I think I closed in somewhere around here. I was in much better profit down there. Exact same situation with my GU trade, I believe my take profit was, it was somewhere, where was it? But anyways, both the trades I closed slightly prematurely. Had I not, and had I let them run on, I would actually have finished my verification now. So it really does make all the difference just holding them out. Like, price is going there for a reason. They don't move the market for no reason. Again, sell before buy, which is the exact same thing. So price puts in the peak formation Monday, Tuesday, Wednesday, setting up. So what we're waiting for, we're waiting, so below double zeros, peak formation put in place above the round numbers. So we're waiting for price to simply trade back into it. And this was the same thing. I'm just kicking myself at the gym, just thinking I've missed the moves now. But then as New York traded, we had a very similar type setup on GU. So you can see before the session starts, again, that creeping trend behavior, just kind of lulling traders into thinking it's an easy short. Session opens, big inducement down, followed by this, and then we like I said, it's fractal. So we have our double top peak formation behavior as the new hour starts. So this is a 2 o'clock candle closing bullish, and then we get an engulfment peak formation behavior. As soon as we see that, shorting this market, and again then picking your take profit and hold it to it. So I believe I closed as price had pulled up again. I basically closed on a pullback, so yeah, it was probably in around this range somewhere. And yeah, as I said, it would have gone on, and that is a thing that's repeating throughout my trading, just seeing the profit and just being too scared to lose it. And then, but the thing is, like, you're actually losing money by closing the trade early. It's like you're scared to lose money, so you close the trade, but you're actually losing out on potential profit. So keep some inventory. See if you are closing your trades early. See how often is that benefiting you. Like, how often. Obviously, you're gonna get the times where price is gonna reverse and not hit your take profit, but more times, provided that you actually have picked a reasonable take profit, if it's at a psychological number, an order block, a liquidity point, price, as I said, it doesn't move for no reason. So really, really, yeah, as I said, if anyone's got any tips, by all means help me as well. But yeah, that's pretty much it, guys. I said I go to the gold trade. I said, yeah, timing and price. Those one £2 trades, and then gold today, timing and price. What I mean by price is price levels, so significant round numbers. So we got your double zeros here. Again, this is the new hourly starts, immediately pushes up, pins above there, tags in institutional orders, and once we get this engulfment, boom, short back down again, straight to the order block or to the beginning of the impulse. So basically, as I said, everyone's speaking the same language, just using different lingo. But yeah, all three trades very similar. This is peak formation. You got your head and shoulders, time and price, just fractals of different trades. But yeah, cool. That's pretty much it for this one. I'll catch you in the next one.